So the growth scare in the marketplace, financial markets, is simply waking up to the fact that there are going to be consequences for the economy that looks like it's not recovering from the last recession. It is not going to recover from the last recession. Whether that means deteriorating economic circumstances that maybe look more like a traditional recession in 2025, that's an open question. It's not necessarily, are we going to see a traditional recession? It's okay, are we going to see deterioration in an economy that's already not operating at its full capacity?
Jeff Snider, host of the Eurodollar University podcast. It is so great to welcome you back to the show. It's been almost a year since we last had you on. So great to see you as always, Jeff. Thank you so much for taking the time.
Oh, it's my pleasure, Julia. It's good to see you again.
Likewise. And I can't believe it's been almost a year. We shouldn't let that much time pass before we have you on, because I know this audience loves hearing from you. And I love listening to your show on the daily anyway. So I feel like, gosh, what a great time to have you on, because folks are trying to make sense with what's happening in markets lately, the economy. Where are things even headed? Since it's been a while, Jeff, kind of let's step back for a moment and start with that big picture like we always do with our guests, just given the amount of time that has passed. So today, where we sit, what is that more of that big picture macro view for you today? And as you know, Jeff, you can take all the time you need to set the table.
Be careful what you wish for, Julia.
Oh, no, you can let it rip, Jeff.
Yeah, so big picture, where we left off was last summer, the U.S. economy was starting to show signs that it was really weakening. We got labor market weakness. The Fed started to even panic about it. That's why they got the 50 basis point rate cut back in September. Then it kind of seemed like, okay, what happened? Everything kind of turned around. It looked like everything was going in the right direction again. It was just a brief scare, no big deal. So you had, everybody was piling into the opposite macroeconomic risk off kind of trades in the summer. And then, you had the rate cuts from the Fed. You had the election. Everybody got excited about that. And you had some other artificial things that happened. And by the end of 2024, it kind of looked like, okay, the U.S. is going to steady itself and move off in a soft landing, if not no landing scenario. But more recently, started to get the sense of all of that stuff that happened at the end of last year that seemed to detour away from the traditional recession in the summer. They've started coming back, especially this past week, as you just referenced. This last week, everybody's been talking about, the growth scare all over again. And the truth is, what happened last year was a couple of artificial things showed up. Some of it was the Fed. There are people out there and businesses out there who believe that rate cuts do help the economy. And so when the Fed, cut by 50, then two more 25s after, there are some people that got a little excited and, optimism shot up and some activity may be related to that. The presidential election, same thing. There's a lot of people who took that as, hey, the last several years have been horrible, so anything different has got to be positive, right? So you had a burst of optimism there. But I think the biggest thing is that we had a lot of economic activity that was front-loaded into especially November and December, not just in manufacturing, but also the services sector, everybody trying to beat tariffs. So you put all these things together, including the fact that so much was front-loaded in terms of actual economic activity. And you look back and you think, okay, optimism surged, and then there was a burst of activity. It did seem like the economy was moving in the right direction after that summertime scare. But now we get further into 2025, and more what you see from the data, and just in real time, is that it was just more artificial than not. There was really not a whole lot of substance to that rebound. And so we're kind of getting back to where we were. We're picking up where we left off in the summertime with the growth scare is coming back. We just haven't seen it quite yet in a whole lot of, and in the same broad fashion that we did last year, where it was really, July into August, it seemed to be everywhere. But I think markets are starting to get the sense that that's the direction that everything is heading. So after you have all those artificial factors, it seems like the rug is being pulled out from under everyone because it was artificial. And when you have so much front-loaded activity, eventually you've got to pay that back. And that's where we're kind of getting the sense here that the payback is starting in 2025. And it's even worse and more pronounced outside the U.S. than it is inside the U.S. You look at places like Europe, for example. Europe was supposed to be recovering. In fact, they're supposed to be recovering every year, and it never happens. But this year, more than even last year or the year before, the European economy hasn't even shown any signs that it's going to pick up. Sentiment has gone in the wrong direction. In fact, we've seen a lot more deterioration this year in Europe than anything positive. So the U.S. is kind of just getting back to where it was last summer, and also getting along with the rest of the global economy, which is still moving in the same direction, even if it looked like for a while there that, the Fed had nailed the soft landing. That was more of another false dawn than anything. So another transitory period where we have the economy that looks relatively strong and resilient, but it actually isn't underneath it. When you get to the real fundamentals of the situation, the labor market, incomes and jobs and employment. I mean, that's the one thing that we saw with consumer confidence falling over the last couple of months, coming back down. For those couple of months last year where everything seemed to be fine, confidence was sky high. People started stop talking about, jobs and incomes. And then, January, February, and especially here in March, all of a sudden consumers are talking about jobs and incomes all over again because we're right back to where we were before.
Yeah, that's okay. That is such an interesting notion, like this kind of artificial nature to the economy and possibly, I imagine, could we throw markets in there as well? Would that be fair to say too, like this artificial kind of lift? Because one of the things I sense, Jeff, just even reading the comment section of folks who watch this show, a lot of people don't feel like it's been such a great economy. I kind of get that sense, like just when I see those reactions, like people say, what great economy? It's not great for me. Is it more of a facade then?
Yeah, there's always this disconnect during periods like this. And you can go back to any recessionary period. In fact, it's weird. You go back to 2008, which you would think everybody agreed 2008 was a bad recession, but it wasn't really that way. People really didn't think that way up until the end, up until Lehman Brothers failed. But even in the first half of 2008, there was this same disconnect where regular people, consumers, just the average man on the street said, this economy sucks and it's getting worse. And you had economists and policymakers and politicians saying, no, this thing is fine. Have you seen GDP? GDP's not that bad. The payroll reports look relatively good. So this kind of disconnect is actually not all that uncommon, but there has been one. This one may be more prolonged than other ones, but the economists were ridiculing regular people who said the same thing, that the economy was bad. And economists called it a vibe session. You saw that in the media for the last couple of years. Oh, what recession? It's a vibe session. Everybody feels terrible, but the data looks really good. And it's really just a difference of perspective. And if you look at, for example, GDP, you look at GDP on a quarterly basis, you think, okay, it's up, it was up 3% in the middle part of last year, it's up, about 2.3% in the final quarter. That's not bad. The payroll reports are positive and they actually accelerated at the end of the year. So how can this be a bad economy? And what's missing from that is the context. And there's a couple different pieces of context they don't show up in the data. First is, of course, purchasing power. Everybody got made poorer for the supply shock because prices zoomed ahead and incomes did not keep up with prices. So first of all, people feel that, right? I mean, you go to the grocery store, you're reminded of that every day. You go buy a new car. If you haven't bought a car since before the pandemic, like a lot of people haven't, right? People who are buying cars in 2018 and 2019 are probably coming back to look at cars for the first time. They're like, massive sticker shock. You think, how did cars get $10,000 more expensive per unit, right? So incomes did not keep up with the supply shock. So already people feel that they've been left behind because they have been. But as far as the economy going forward, if you're looking at the payroll report on a monthly basis, it looks fine. But what you don't realize is that the payrolls in the U.S. economy are 5 million short of where they need to be for an actual legitimate recovery. So in one sense, it's not necessarily a recession or a vibe session. It's the fact that we never recovered from 2020 and 2021. And that's what people feel. What they're really saying is, okay, you guys talking about a strong economy, but we're still stuck in 2019. We still haven't got back to where we were back then. And so that's the disconnect. If you look at the data on a monthly basis or a quarterly basis, it seems to be moving along at a relatively decent rate. But what you're missing is that context, which means that, okay, the payroll report was 140 some thousand in January. What it really needed to be was 640,000 to try to get us back to where we were before, to get back to a real recovery. GDP was 2.3%, but it really needs to be 8%. So that's the difference. People feel that difference, even though for most economists and politicians and the people just casually observing the economy, they don't see it in the economic data. The economic data looks good, but the economy sure isn't.
That's fascinating too. Like we haven't seen that real recovery. It also makes me wonder if things were so artificial propping it up too. Like was that also a mistake too? Kind of like letting things flush out. Maybe I don't know exactly where I'm going with this, but I'm just thinking me personally as like a millennial, for example, I want to buy a house, Jeff, and I complain about it all the time on this show. And yeah, there's sticker shock for cars, but my goodness, there's sticker shock for buying a new home. It's pretty crazy. And there's not much inventory either, which I get that dynamic too. But it kind of feels like, we did all the right things and I don't really see the entry point, or at least one that would make sense.
Yeah, there's a huge dynamic here. And again, I don't want to relitigate the lockdowns and everything else because, from the perspective of the government, I mean, they're like, hey, we had to do something, right? I mean, we get into a whole discussion about whether or not that was a wise policy to begin with. But what you have to realize is that, what the Keynesian philosophy that dominates economics is it doesn't matter what governments do. As long as they inject money into the economy, that's a positive. And it may be in the very short run basis. Whenever governments intervene in the economy, they create massive distortions. And the distortions usually end up over time revealing themselves to have been harmful. You just talked about housing. That's one of the most harmful distortions that we've seen. Prices absolutely soared for no legitimate economic reason other than the fact that we had lockdowns. We had governments who, threw a bunch of money at the economy, and those who had the means took that money and put it into the housing market. A lot of people put it into the stock market. Those are not economic trends or based on economics or organic conditions. Those are based on distortions that were created by the pandemic and then the government response to the pandemic. And when you have those types of non-economic distortions, it means people are going to win and people are going to lose. And more often than not, the category of the losers gets to be much larger than the category of the winners. You get left behind. It's another angle on the same thing. So what we're really saying here is when people talk about the markets, the housing market, the stock market, the real economy, when they say the economy sucks, the housing, I want to buy a house, what they're really saying is there was these distortions a couple years ago that we have not been able to surmount. We have these massive interventions that created all of these harmful, and really were harmful, really changing how the economy worked. And we still haven't been able to get back to where we were in 2019. That's what really everybody's saying. We would like to go back to 2019, but we can't see any way back. And that's what people really get angry. And it's not just the US. And that's why we've seen governments turn over all over the world. You go to Europe, you go to New Zealand, you go to Australia, even Japan, the ruling party there has been threatened. So you see a lot of people, a lot of the voting public is upset about the fact that they feel the same thing. And as you were saying before, you don't get that message. You don't get that honesty from officials and politicians, and certainly not central bankers. They're not going to sit up there and say, yeah, we kind of screwed everything up the last couple of years. Sorry about that. Instead, they tell you that everything is just fine. Our policies work great. Don't complain. Stop whining. That's the message you get. And people realize this is frankly garbage. And so that's where a lot of that anger comes from. The housing is a big one. Yeah, absolutely. Because that really goes back to 2008. There's actually a bigger story there. But in a lot of ways, everything else goes back to 2008 too. So what we have is the 2020s economy that is distorted and harmful and unproductive and all the negative words you can throw at it, didn't recover from the pandemic. And that was after not recovering from 2008. So you've got a massive shock in 2020 following a massive shock in 2008. And it just seemed for most people, like they keep getting worse and worse and worse. Their position they get left further and further behind because that's actually what's been happening. So people have a difficulty articulating that, and they have difficulty putting their finger on it because you don't see the data anywhere in financial media or any media, but it's there and it's actually a real thing.
Yeah. So from where you sit, Jeff, where do you see things headed? You mentioned the growth scare, but is that not just a scare? Like it sounds like we're not necessarily on the best path going forward, maybe?
Yeah, there's a couple different things with it. The growth scare, when you use the term recession, for example, that's what growth scare is really about. Growth scare refers to the fear that the U.S. economy or some other economy is going to tip into a recession. And we have to be careful here because what we just talked about was the fact that the U.S. economy and the global economy never really left the last one. So when we say growth scare, what we're really saying is not in this sense that we're going to see another recession develop in the same way that, we picture from, 1990 or 2001, the traditional type of recession, because everything about this current period is completely unique. We're faced with a very unique set of circumstances that don't look like historical periods in the past. So many people use the term growth scare. What they mean is, GDP is going to turn negative and the payroll report's going to become negative. It's going to look like the recession in 2007 or 2008. What we were just talking about isn't really a growth scare in the sense of a traditional recession, as it is the market's waking up to the fact that there's something wrong in the economy. Now, what actually is wrong in the economy, that's where a lot of the confusion comes in, because people are looking for a traditional type of recession rather than realizing we haven't recovered from the last one. So the growth scare in the marketplace, financial markets, is simply waking up to the fact that there are going to be consequences for the economy that looks like it's not recovering from the last recession. It is not going to recover from the last recession. Whether that means deteriorating economic circumstances that maybe look more like a traditional recession in 2025, that's an open question. I think that's where we left off in last summer, was that some of the fact that we hadn't recovered last summer and then, had some deterioration on top of it. It started, the growth scare then was the economy and the marketplace reacting to the fact that, maybe we're going to see the more signals of a traditional type of recession within this overall context. And that's kind of where we're back to. It's not necessarily, are we going to see a traditional recession? It's okay. Are we going to see deterioration in an economy that's already not operating at its full capacity?
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. When you talk about the markets waking up, can you elaborate a bit more there? Like when you'll see that kind of reinforced, like, okay, the market's really waking up? Because I know stock market's back up today even, but I imagine those concerns are certainly still there. What are the signposts that you will be looking for specifically as it relates to the markets? And maybe it's not just in equity markets. I imagine looking at fixed income, for example, as well, you'd probably start to pick up some real signs there.
Yeah. So financial markets, you talk about the stock market and equities. Equities want to go higher. They always go higher except for one circumstance, which is the one we were just talking about. Everybody knows that during a recession, the recession that we all recognize as a recession, stocks do poorly. So everybody's going to buy stocks until they see signals that look like the traditional type of recession. That's what happened last summer. We started to see some payroll numbers that look soft. Some of the other economic data goes along with it, look kind of soft. So people started to sell, and that wasn't just stock market, that was spillover from other things. But you started to see more signs that looked like the economy was moving in the direction of what looked like a traditional recession. People got a little nervous about it because of that underlying belief that stocks do poorly in recession. It's not just a belief, it's true. The only time stocks have gone down really in the last 40 years is during recessionary periods. So everybody I'm going to get out of the marketplace when I see signs that look like a traditional recession. So the market over the last several months, despite the fact that there seemed to be a lot of optimism, you look at the S&P 500, it's kind of gone sideways since December. Same thing for the NASDAQ and some of the other major indices. They've kind of hit a pause here. And more recently, we've had more volatility as this growth scare has come back into mainstream consciousness, which is, again, are we going to see signs that look more like a traditional recession? Because if we see signs that look like more like a traditional recession, everybody's going to want to sell their stocks. And of course, you can't wait that long because it'll be too late. Everybody will have already sold. So you have to sell before you think that we get to that point where everybody sees the signs of a traditional recession. So even a little bit of weakness starts to trigger that risk off type of situation in the marketplace where people are looking for the exits, because as it looks more and more likely that you could see those signs for a traditional recession, that means that there's going to be an avalanche of selling. So that's where the itchy trigger finger has come from over the last couple of weeks, last week in particular, because it looks like, okay, we're getting back to where we were last summer. Well, last summer we were seeing those signs of a traditional recession. But on the flip side, in the bond market's been all over this economy from the very beginning, really going back to 2022 and really 2021. The yield curve inverted in 2022. That was the market saying this was not an inflationary period that was going to get out of control and stay out of control. Eventually, as far as central banks were raising their rates, they were going to have to come back down again, which is where we are today. So the bond market has been saying all along low growth and inflation expectations, which meant that the economy never recovered from the 2020 pandemic and the distortions in 2021, the supply shock and the impoverishment. So it's, low yields and inverted curves and all that have been saying all along, this is what we've expected. We expected a period where growth was going to be well below where it needed to be, and that central banks were going to eventually react to that low growth situation once they got over their fixation on consumer prices, and eventually would have to turn around and start lowering rates, which again, that's where we are. So the stock market, it looks like it's in a different place than the bond market because the stock market is looking at different signals and focusing on a certain set of signals that haven't showed up, where the bond market is just looking at the overall whole, this economy that isn't growing, that isn't recovering, and saying we see more of the same up ahead. And so you get the fluctuations in interest rates that are basically about how much weakness there might be up ahead on top of the weakness that we already have.
Yeah. I should mention, I lied, Jeff. All the three indices are lower today. I saw the futures were up earlier before we hopped on here. Not that like I would take us any single day as where things are headed by any means. But okay, so question for you then. When we talk about rates, what do you think, what is more of your outlook for the Fed this year?
Yeah, so the Fed has been back and forth, right? And it's not just this last year or the last 6 months or so. They've been back and forth since really 2022. Mm-hmm. And it's because they have no idea what's happening in the real economy. And I know that sounds ridiculous because anytime there's a question about the economy, who's the first face you see on TV? It's always Jay Powell. And he sounds very authoritative. And he's got all of the background and all of the visuals and everything that presents an authoritative figure. But he has no idea what's happening in the economy. And you can see that by how the Fed has behaved as the economy has developed, especially consumer prices over the last couple of years. So you go back to 2023, the Fed was higher for longer. We're never going to cut rates. And then suddenly it was, oh, yeah, now we got to cut rates. And then the consumer prices start to accelerate again. They're, oh, we can't cut rates. Now we got to go back to higher for longer. And as soon as consumer prices back off again, like they're doing right now, the Fed will start cutting rates all over again. So they're basically, when they say they're data dependent, it's the literal truth when they really shouldn't be. What they mean is we have to wait to see what the last CPI was to tell us what we think about the real economy. That's not how this is supposed to work. So the Fed is just fluctuating back and forth based on the fluctuations in the real economy. As I say all the time, nothing ever goes in a straight line. So you would always expect that consumer prices, they accelerate, they decelerate, they accelerate, they decelerate. You can't get caught up in that vacillation, which the Fed does. But overall, the bond market has been saying it doesn't matter what the short run looks like. The long run continues to be the same. So it doesn't matter each time the Fed flip-flops back and forth. Over time, they're going to consistently move in this one direction, which is toward lower rates. And that's exactly what we're getting. So the Fed, they were higher for longer right up until July last year. And then suddenly, like the marketplace, the equity marketplace, they started to see these signals that look like a traditional recession. And of course, they backed off their inflation bias and went into, we got to cut rates. And then seems after we got that artificial bounce at the end of last year, they went back into, okay, everything looks steady. Let's focus on consumer prices. And now we're back into the growth scare again. Consumer prices, if they decelerate, means what's the Fed going to do? The Fed's going to cut even more. So the markets are basically saying, ignore this back and forth, ignore the short run. Over the intermediate and longer term, rates are going to go lower growth and inflation expectations because that's where the economy is heading. What we don't know is how we get from here to there and what it looks like in between. Because there's a whole range of scenarios. We talk about lower growth expectations. It could be a traditional type of recession. We could see the next couple quarters where we have negative GDP, we have negative payrolls, we have all that. Or we could continue on in this lack of recovery scenario for years, which would be the worst case, by the way, where we don't have enough growth. Payrolls stay positive and GDP is, low, but it's never nearly enough to create a recovery. Which would be the same thing as low growth expectations, but it's a very different set of scenarios. So what the markets are basically saying is exactly what we've seen over the last couple of years, rates going down, economies that are performing well below what they're supposed to, what we need them to, and all the consequences that go along with it, whether it be central banks lowering rates, governments that don't get with the program are going to be tossed out of office because there's a lot of angry voters. And you have that kind of instability in economics as well as politics, but also every once in a while, it actually might get into the financial markets like stocks or cryptocurrencies that suddenly experience this getting smacked with some reality every once in a while.
Yeah. How, I'm almost going to ask, like, as an investor, like, how do you even think about, like, navigating this environment? And have you been in a similar environment in your career?
Yeah, it's always difficult, especially when your main exposure is to the stock market. And the stock market has gone off the rails, over the last decade, really since 2012, 2013. It's completely detached from any fundamentals. And let's be honest, stocks aren't really fundamental to begin with. And nobody wants to hear that, but that's the exact truth. So stocks are like what John Maynard Keynes said. It's a beauty contest. And in the beauty contest, you're not judging the beauty of the equities. You're judging how the other judges will judge what everybody else thinks is beautiful. So what you're really saying is, you're buying stocks because you believe everybody else believes that everybody else will buy them too. And so the reason why everybody sells with a recession is because everybody believes that everybody knows you sell stocks in recession. So it's really difficult to navigate that type of environment where the recession signals themselves they're nothing like we've seen before. They're exceptionally cloudy. They're not clarified at all. So, you can take one of two paths here, and there's really three paths, but one of two paths is what you could just sit out and say, okay, the market's just not worth buying. It's not worth participating in. But if you do that, you're watching stocks go up and up and up and up, and you're giving up returns along the way. So then you want to participate in these rallies like everybody else does, but then you have to know when to get out of the rallies, because that's, as everybody knows, when the real risk off hits, you won't be able to get out of it in time. And so you risk riding it all the way down to a bottom and giving back all the gains that you thought you had before. It's incredibly difficult to really have to decide what it is you want to do and what you want to accomplish and how much risk that you want to take along the way, realizing that what you're doing, you aren't really investing in companies, not really investing in the economy. You're investing in other people's perceptions of both of those, which makes it more difficult. And it's really a psychological game rather than a fundamental macroeconomic game. And the only macroeconomics is really, again, these recession signals that everybody's looking for. If you think you can tease them out before everybody else does, then maybe you have a way to get out of the marketplace before everybody else. But that's really the difficulty here.
Wow. That's such an interesting way of putting the psychology bit. But as you point out, like the recession signals, a lot of them are cloudy. Maybe for you, are there any that are like maybe less conventional or alternative that you look for that are pretty useful?
As far as, timing the stock market, forget it.
Oh my gosh.
That might be an impossible task.
I don't know if
you
anyone
can get some signals in, fixed income and some of the other marketplaces, but there's really no set of signals or correlation you point to that says this is foolproof, that tells you this is when the economy is going to start to exhibit, the exact signals that we're looking for in order to sell our risky assets. I wish that was the case. I wish it was that easy. Even with the bond market, you talk about yield curves and things like that. It's all about probabilities. So when the yield curve is inverted, all that really says is nothing more than, over the long run, there is a higher probability that interest rates go lower than they go higher. That's all it really tells you. And then we have to fill in the blanks about what that actually means. And the reason why the inverted yield curve is associated with recession is because more often than not, during the post-war era, and really going back into the 1920s, when you have a recession, you see interest rates that tend to want to go lower because of the fundamental value of interest rates. But here we are in the 2020s, where we were presented with a different set of circumstances, where you have the inverted yield curve wasn't necessarily pointing toward a traditional recession, but more this, lack of recovery. We haven't escaped from the last recession. That's what it was really telling us, and all the consequences from it. So to try to fill in the blanks from all these probabilities is an incredibly difficult challenge. But that's really what the markets are giving us, is just a set of probabilities. And you have to do your best to try to fit them together with not only what other markets are doing. I'm not talking about, like currency markets or derivatives markets, but also what the macroeconomic data itself looks like, because that gives you a clue about what the underlying circumstances can be as well. You've got to put all these pieces together to try to put together a comprehensive whole. And it's incredibly difficult to do. I wish there was a set of signals that you could just fall back on and say, okay, when this does this, then do that. But we live in a dynamic world. And even if you could set up a set of signals for that, it would be outdated tomorrow. The world always changes and always moves on. So it's really just trying to look around and get a good sense from a wide source of all sorts of data, market as well as macroeconomic.
Mm-hmm. So when you look around, then what is your expectation? Like, what is the base case for you today?
The base case for me is that we have the same economy as we had before, that it's underperforming in a lot of different ways. We have payrolls that's not, the labor market that's not enough, which means income's not enough to keep up with growth. So that means that, we're going to be locked into this continuous downward process where we keep getting further and further behind, which produces more and more angry people, which leads to instability in a whole lot of different places. At the same time that even, equity markets and cryptocurrencies have got the sense that something's not right here too. And so you get financial volatility on top. So the base case here is that nothing materially changes. We continue to move along in the same sort of unrecognizable recession, which leads to a whole bunch of confusion and outrage and a whole lot of negatives, where central banks and politicians and everybody else around the world are going to react to those same things, not really understanding what they're doing. All they're really reacting to is people are pissed off. And so we need to make people happy. We don't know how to do that. So governments are going to continue to act, and they're going to overact and overreact. Markets are going to be volatile, and the economy is just going to continue to suck and suck and suck until we get to a point where all of those distortions from the 4 years ago finally lead to a more stable economic state. And the more stable economic state, the long run state, that's up in the air with what that actually means. And I don't think it means anything good. But that doesn't preclude the possibility, like I said, that we do have a more traditional type of recession along the way, because there's a lot of signals in a lot of different places that suggest as these economies continue to underperform, their underperformance is actually accelerating, which means it could degrade into, we get to a period where we do have mass layoffs, because that's the one real thing that people associate with traditional recession, right? It's when companies just start firing and laying people off, regardless of anything. They just widespread layoffs everywhere. Where this current recession or the current lack of recovery has been really marked by the lack of hiring. So at the very least, we expect that companies are going to continue to, hire as minimally as they possibly can. And whether or not that leads to eventually the mass layoffs that everybody expect and associate with recession, it's tough to tell. I mean, companies have held on this long. So it may be that they keep doing it. But either way, the overall, the baseline case, the markets are still saying that at the very least, nothing changes.
Then, okay. So what for you is the biggest risk right now that, maybe is keeping you up at night?
The biggest risk is that you have some kind of blow up, that it gets beyond sort of the stasis where everything's just kind of, underperforming, and something actually, the underperformance leads to a negative consequence, some kind of negative shock. And it doesn't necessarily mean something in the United States. I'm not talking about, it could be a wave of mass layoffs, but that may not necessarily be the case. It could be something like China, for example. The banking system over there is experiencing right now about a pretty serious illiquidity. You see bond yields absolutely crash over the last couple months, going back to December, suggesting that the marketplace is uneasy about something in China. Of course, China, we have less information than we do here. So it's even more difficult trying to figure things out there. The Chinese have been struggling with not just economic difficulties, but banking difficulties and monetary difficulties too. So it could be that this underperformance, this lack of growth in the overall general global economy leads to, at some point, it just goes on too long, and it leads to some kind of shock, some kind of spark that then triggers some kind of, I don't want to say necessarily crisis, but some kind of second and third order effects that lead to more than just the continuation of the lack of recovery that we have now. It leads to something that looks like not just a recession, but maybe a really bad one that spreads then around the rest of the world. Because the longer we stick around in this economy that hasn't recovered, the greater the chances of something like that happening are. When you have lack of economic growth, it leads to instability, and instability leads to a higher probability of more instability and greater and accelerating instability. So there's a lot of potential for something like that to happen. And we've seen that a couple places along the way. I mean, you go back a couple of years, 2 years ago, when Silicon Valley Bank failed. That was sort of a reminder that we have this instability, and this instability can trigger substantial backlash. And while most people think that the banking crisis in 2023 was a one-off thing, you look at any of the economic data, especially banking data and market data, everything goes back to March of 2023, which means that there were longer run consequences from suffering that, even though most people believe that we got past the banking crisis and the Federal Reserve did did a really great job about it. The banking crisis has left a longer term imprint on the overall global economy and its trajectory. So we could actually have something like that happen, another bout of instability that leads to even further longer run consequences, even if we don't recognize them right away. I think that's the real downside case, is that the longer we stick around in this shape, and it looks like it's going to continue on for at least a foreseeable future, the greater the chances of something like that happening.
It's kind of interesting to think about too, like those longer run consequences of something like Silicon Valley Bank. And it just kind of makes me wonder, one of the things about you, Jeff, you are like the foremost expert of the Eurodollar money system, which I know it's described as a bit of a black hole. It's quite confusing to a lot of folks. I want to say it was like Hugh Hendry who first put me on to you because he had referenced you in like our very first episode. But it kind of makes me wonder too, when we talk about global consequences or implications, does that kind of all stem back to, we have like the global reserve currency, if you will, the US dollar? Is that one of the reasons like everything's so interconnected and like we're kind of better off than everybody else right now?
Well, it looks like we're better off. In many ways we are, but we're not categorically different, as I think a lot of people have been led to believe. It seems like the U.S. is an island of stability in an ocean of instability, and that's not actually the case. We might be better off compared to other places like Germany, for example, or New Zealand, which is maybe the best example of an economy that is experiencing the traditional type of recession signals. But we're not categorically different. And you're right. It is the global reserve currency, this Eurodollar system, which creates an intricately connected and complex maze of all these connections in the real economy as well as financial marketplaces that mean that there really is a global economy and there really is no escaping from it. You can go back to any number of examples in history. The 2001 recession, the dot-com recession, which a lot of people think have been left to believe that it was about September 11th, first of all, but that it was just a U.S. experience. There was a dot-com recession all around the world because when one part of the global economy gets itself into trouble, chances are that the rest of the global economy is going to get into trouble as well. So in some ways, you're right. The Eurodollar system does insulate the U.S. economy from some of the worst consequences, at least since 2008. We've seen some of the more negative consequences emerge in emerging markets in places like China, but it doesn't mean they were categorically different. So as the Eurodollar and the reserve currency links all these economies together, if you see tremendous amount of weakness and deterioration in places like Europe or Asia, chances are that deterioration is going to eventually show up in the United States too. Now, how it does and to what degree it does is an open question. As globally synchronized as everything is, that doesn't mean it's exactly the same in one place after another. Usually what happens is one place really gets it bad and other places are kind of less impacted. But there is a high degree of global synchronization. So like I said, if you see Europe weak and struggling with something that looks like a traditional recession, chances are the U.S. isn't going to be really fine and hitting its soft landing.
What's your, okay, what would be like the positive scenario or the positive outcome from where you sit? Like, is there a way to mitigate this or avoid it, rectify the situation? Curious, like what that might look like if there is a mechanism for doing so.
Yeah, there's actually needs to be two, right? Because we're talking about we're sitting in the long run consequences of 2008, which was its own set of problems and circumstances relating to that Eurodollar system. And then we have the problems of the 2020s, which is the aftermath of the pandemic. So we have to navigate two structural problems at the same time and hope that both of those things go right. But taking the second one first, the pandemic, what we need to have happen is the global economy to resettle in a stable equilibrium after all of those distortions. The distortions meaning the pandemic itself, the lockdowns that resulted from, because let's face it, the lockdowns themselves destroyed an enormous amount of economic potential. That's one of the things that really bothers me the most is that politicians sold this idea that they can just shut down the global economy and then start it all back up and everything would be just fine. I mean, who actually thought that was going to be the case? They destroyed lots of small businesses that never came back, and we have to pay for that. And then on top of it all, we had a phase shift in prices, which means that we impoverished the entire world. How was that going to go good? How did anybody think that was going to turn out to be positive? I know I'm smiling because at this point, you can only just laugh about this stuff. But that's one of the, we have to get to a state where we pay for all of the consequences of 2020 and 2021, which means that we have to, for example, manufacturing, the car business, a really good example. The car business is right now struggling because during the lockdowns and during the price illusion, the supply shock, prices zoomed ahead. And it looked like the car business is doing better than recovering because car makers' revenues were soaring. But the truth of the matter was that was all price. It was all a price illusion. They were actually selling fewer cars than they were in 2019. So they were making fewer cars and selling fewer cars. And for a while there, they were making more money doing it because of the price change. But eventually, what you think is, okay, we're selling fewer cars, but eventually everybody says the economy is recovering. So we're going to start selling more cars like we expect. So we're going to hire people anticipating that we're going to sell as many cars as we did in 2019, at the very least, if not more, because this economy is red hot. But after a while there, when the actual volume doesn't increase, in fact, it actually gets worse, companies start to realize, okay, we had more revenue, but we were doing less things. Do we need all of these workers? We don't actually need these workers. They're just standing around, sweeping off the shop floor. They're not actually being productive. And the longer this goes on, the more you say, we're not going to recover here. We're not going to need to make more cars. We don't need all these factories. We don't need all these workers. And so the auto business, which looked like it was booming a couple of years ago, suddenly now looks like the sickest part of the global economy because it has to adjust to the actual volume that's produced out of its factories. And adjusting to that volume means we got to fire workers, we got to close facilities, we got to trim overhead, we got to shrink. And that's a microcosm of the entire global economy. The entire global economy has to readjust to the actual volumes. And the volumes are a lot less than people think because they got caught up in the price illusion of the supply shock and what everybody calls inflation, which really wasn't, was a supply shock. So the global economy has to resettle to its stable volume. And maybe the positive part of that is it's not as bad as we think it is. Maybe there's a painful adjustment coming, but maybe it won't be as painful. Maybe it will come up, maybe it'll happen quickly instead of, year after year after year. Instead of dragging this out into the 2030s, maybe this happens in 2025. Who knows? The markets don't think it's a possibility, but anything is possible. So the economy settles at a stable equilibrium for the 2020s, and then it can start growing again from there. We also have the problem of the 2008 crisis, which we never recovered from either, which is a very different set of circumstances. That's the monetary system that's broken, which is going to require basically retooling the entire thing, which is a much bigger, deeper, and more intensive problem than people realize. You can't just change a reserve currency. It's something that requires a whole lot of effort. That's a whole separate conversation to begin with, a whole bunch of landmines that go along with it. So you need the reserve currency system that needs to fix itself on top of what we have in the 2020s. But that's not impossible either, and expect that at some point that these longer run problems will settle themselves out. And once they do, hopefully sooner rather than later, then the future looks bright because we've had a period of, going on 20 years now. We've got a lot of pent up innovation and demand. If we start getting some of these economics right, could lead to another period like the 80s and 90s where you see just massive prosperity. So long run, I'm incredibly optimistic about where things are going. The problem is getting there first and what things look like when we do get there, and hoping that things don't get too bad before we do get to that point.
Mm-hmm. And maybe part of that, Jeff, is getting rid of a lot of the artificial parts of propping things up.
Yeah, that's a huge part of it too. That's one of the symptoms and consequences that goes all the way back to 2008 too, right? We've been conditioned to believe whenever the economy is underperforming, we need some central government to do something, right? It's a central bank needs to stimulus or the fiscal spending or something. And fiscal authorities, the more they do, the worse they make it, because let's face it, fiscal authorities are the absolute worst when it comes to resource allocation. They're inefficient, they're wasteful, they're unproductive. And so we have this weird trap that we're in. The longer the economy underperforms, the more we're conditioned to go running to the government to fix it. And the government, of course, is going to try to fix it because it doesn't do it's got to keep the voters happy. And the more the government tries to fix it, the worse they make it because they make the economy even more distorted and even more inefficient, which means that people are going to be pissed off even more, which leads to more government spending. We're just locked in this self-reinforcing spiral. We can't seem to get out. And you're right, Julia, that's part of getting out of it, is to cut off the government keep the government out of the real economy because they don't have any answers. The answers are all going to come from the private economy, not from the government sector, the public sector. But how do you get the public sector to realize that they need to stop intervening and interfering in the real economy? Maybe there's some hope with Doge and in what the Trump administration is pursuing, but then you see other places around the world that are going in the opposite direction. Germany's a perfect example. Their government collapsed because for the longest time they said the economy was just fine, and Germans got fed up with that, along with some other issues as well. And so the incoming government comes in, historic election loss and everything else. The incoming government comes in. What's the first thing they say? Oh, we need to build up our military and increase infrastructure spending. It's like right out of the frying pan and into the fire. But that's what politicians are conditioned to do. And what needs to happen as far as that goes is the voting public needs to demand that politicians get out of the way, more and more get out of the way and stop interfering and intervening. But that's an incredible challenge when things aren't going right. Politicians feel the need that they have to get involved.
Yeah. Well, Jeff, I have to say, I love having you on this show. I am not going to let another full year go by before we get you back on if you're open to doing more with me. But I love listening to you. I love learning from you. I love listening to your podcast, Eurodollar University. So before I let you go, take a moment here. Please let folks know where they can find more of your work. I know you do amazing deep dives. You have your daily podcast. Let them know where they can follow you on social, and any parting thoughts, anything that you would like to leave this audience to think about. The floor is all yours.
Oh boy. Thank you for that. Yeah, I'm at Eurodollar University. I have a YouTube channel, Eurodollar University. As you mentioned, we explore this Eurodollar system, what it is, and really get into the deep details, not just of what's going on today, because that's obviously important, but we also need to understand the background. What is this Eurodollar? What does it actually mean? What is it supposed to do? What is the Fed? What is the Fed supposed to do? We dive into all of these things that, let's face it, the economics is just kind of left behind. There's a huge gap in everyone's knowledge because of economics and where it's gone in a lot of different wrong directions. So we're trying to fill in the gaps of what is money? What is the reserve currency? What is it supposed to do? How does it impact this economy or that economy, or why are all these economies actually appear to be globally synchronized? What are the signals that we can use to define these probabilities that I was talking about? What is a yield curve? What does a yield curve tell us? What are derivatives? What are FX? We really get into the details of what the monetary system is and all of the useful information that it does give us. While we would like more information, it is perhaps the most useful information that we have. So we try to decipher that information, what we're seeing today, and all the background material of how we got to that place. And you find all the information about what we offer at Eurodollar University at our website, which is eurodollar.university. As you mentioned, I got subscriptions there. I do a daily deep dive analysis where we go deep into these topics. I did one last week on the Mar-a-Lago Accord, which there's been a lot of whispers that there's a Mar-a-Lago Accord going on. In fact, I did an interview with Eric Townsend in Macro Voices about this as well. What is the Mar-a-Lago Accord? What might it look like? Would it succeed in the current system? So that's what Eurodollar University is about, is really getting into these topics and these details. As far as a parting shot and parting words here, I think it's really about understanding where we are today. Is that it's not in a good shape. We're not, the economy in the U.S. seems like it's an island of stability. It's really not. We're much worse shape than people realize, and because of that, there are all of these potential consequences that could still lead to a bunch of negatives up ahead. Risk off. We saw a little taste of that with the growth scare this past week. Realizing it's not really a growth scare. It's the certain parts of the marketplace coming to grips with reality. Because for the longest time here, we've been living, the stock market in particular, has been living in an alternate reality. And every once in a while, it's forced to pay attention to that. So my last thought is just to realize where we are today is very different from what you hear. And that as you started out with, the people in your comments section who are saying, where's this great economy? Those people are right. They've been right all along. So don't ignore all of these signals that say things are not moving in the right direction and not going well.
Jeff Snider of Eurodollar University, I just want to say thank you so much. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas. Really appreciate you stopping by, helping all of us learn and get better. So thank you again, and look forward to our next conversation. Really appreciate you, Jeff.
Oh, it's my pleasure. Always fun to see you.